Hello, everybody. This is Coach D here giving you the stock report, but taking a look at the sectors. Now, again, I want to kind of remind you how the stock report works. So I've got the post here, and what we're looking at is just kind of remember that this, the market 20-year seasonal average by month. This is a very powerful tool just to kind of get an idea of what we're looking at. Now, if you really look at what we see here is month of January is what we're looking at here. Tends to oscillate early on and often will give a drop. Now the market tends to put in a bottom and put in a real good rally that doesn't really get started until March, but it tends to run through May. So that's the most bullish trending time of the market. So when you're looking at the market right now, you got to really kind of pick it by the sectors. Now, if you look at it by the sector groups here, you can again use these as a good reference guide if you want to see who does best in January. Tech ekes it out, and healthcare tends to eke it out. If you look at best performance for January, XLV, healthcare, XLK, technology. Worst performers are basic materials and industrials. You'll notice that our stock report is the actual stock picks are going to be heavy in those areas on the bear side, and on the bull side we tried to pick some of those that match the best sector. And then you'll notice that it kind of just an interesting point that the industrials and basics here perform worst in January, recover and do okay in February. And you'll see that technology does well here, but gives it up in February. So you got to kind of look at some of those relationships. And it is, again, always good to look at this chart, for example, give you an idea of, again, those 9 sector ETFs. And what you notice here is that out of the gate, the majority of these are dropping for January, dropping XLK, that's the sector that's up. XLP tends to be down for January. Again, this is 20 years worth of data on average. XLV, healthcare, tends to be up, and cyclicals tend to be more sideways. So that's just an overall seasonal outlook for you. Let's go ahead and drop back here. We've already done that. And let's drop in and talk about our broad market spider ETFs and look at those sectors by group. And I've got them laid out here. And let's, across the board, you're seeing a lot of things overextended to the downside. But let's go through these. Let me maximize that grid cell. And start out with the basic materials. They, again, tend to beat up this time of year. They are what I would consider range down, meaning, the range you see in here, kind of ballparking it from here. Well, that doesn't want to play nice with me. Let me use my regular drawing tool. Kind of look at like the size of the range. Boom. Same type of thing, range down, but there's room to that key support zone, and it's closing low, bearing down. And you look at some of the stocks in that group. Yes, it can put in a short-term recovery, but expect another drop. So it's kind of what I'm seeing on the basic materials. Here we got the energy sector, and now here, energy sector, I expect to do very poorly. Here's the key support zone that broke, and it's breaking down, and it can certainly, as far as this range goes, I mean, that's not atypical. That's actually a pretty typical swing range for it, but yes, it can go more, and there are bigger ranges here for energy. So it can certainly take that zone out and give us a good run. So we're bearish on energy. Financials, I am loving because they tend to do really poor in January, February, but also key support zone. It can break right now. Now it's come down into here, so we could watch it kind of consolidate in here. But if it breaks that key support zone, that could be a good time to get bearish on some of the financials and look at some of those financials that have reversal patterns or continuation patterns to the downside. Okay, next on the docket is the industrials. Now, we're pretty bearish on these right now. They do have some room to drop. Same kind of story here across the board. Whole market seems a little overextended. So you see these big drops here. Now look, I mean, from the bottom of this candle, it's a big drop. To the next candle, that's a smaller drop, even though it closed near the lows. Big support zone in here. Keep an eye on those. It is definitely an area where we don't mind being bearish, but watch for bear retracements. Let's go ahead and hit the next one here. Technology has violated its moving averages, broken down below its 20-period moving average. 20 and 50 have crossed here. 200-period moving average violated here. When again you look at it, that's a pretty good size drop for it, bigger than that range. It certainly can go more, but again, technology, if we were to back this out here, okay, so technology, the reason I brought in more history on this one is because this is one we would watch for strength in January. However, not sure we're going to trust that, but you're kind of ballpark channel here. You know, we got it down below those moving averages. That's a tough one to call in general, but watched to see if it reverses with the market. Again, kind of just looking range down. Consumer staples doesn't tend to do so hot. Here we've got a double top M for murder, a breakdown, but it's closing right at that 200-period moving average. So that 200-period moving average trend zone, whoops, let's see if we can redraw that here, kind of ballpark trend zone. It can hold, but don't necessarily expect it to. So, not overly bullish on that. Now, utilities managed to kind of buck the trend. When the market's getting beat up, utilities kind of held their own. And it's got that kind of ascending type triangle look to it, coming off of significant lows here. Not overly bullish on it, but more neutral. So utilities would be an okay place to hold, especially if they pay a dividend. Healthcare. Now for healthcare again, let's go bring in a little history here. Okay, now with healthcare, you've got a big bottoming zone through here. Now it has put in lower highs. It's definitely broken down through here. Tends to be more recession resistant, but it's also, if you were to go from here to here, let me draw up the Fibonacci's for you on this. This one could be one that gives us a support bounce a little bit stronger than the others. So here's your support resistance neighborhood. 618 would be the big zone to watch. It's trading pretty close to 50%, but 618. So watch the market, watch healthcare. There's a handful of candidates in there, and you get a short-term reversal. Even if you do get that reversal, though, keep in mind that it broke lows here. So you have to kind of look at it from, okay, yeah, it broke those lows. If it does bounce, you have to watch out for kiss goodbye in that neighborhood. So that is your healthcare sector. And last but not least, consumer cyclicals. See, what I'm seeing here is very, very similar to everything else. Big downward run below moving average. Key support zone break. Whatever trend zone it had, I'm guessing is violated. And you're just going to kind of watch that support zone. So overall, this market's going to be interesting this week. I would say we're going to keep an eye on that broad market. And just as far as the broad market goes, let me pop in the E-mini S&P one more time and just kind of reiterate my expectation for the week would be a bear covered, nothing super strong. So as you look at the list of candidates we got on the lists, some of them are set up for rallies, but keep in mind that that's also a kiss goodbye zone up there. So that 2,000 number was a big one. Here it came down to 1,900. Watch for it to maybe not even get up there. But that's the idea of what we're seeing in the market this week. Keep an eye on that economic calendar and keep an eye on any major market catalysts. This is Coach D with TackleTrading.com. I hope you enjoy the stock picks this week.